So in today's video, I'm going through this topic about US market is overvalued. Yesterday, I saw that there's this tweet, right, say that, the largest 7 stocks in US, I think that was referring to US Magnificent 7. So they add up together is like larger than the entire Chinese stock market. So I was thinking, is it really that big? So I just checked the from the US market cap just to see whether it's really that big. So and I found that it's quite interesting. You don't even take the Magnificent 7, just the 3 largest US companies, right, which is Microsoft, Apple, and Nvidia. These 3 added up together is almost like 10 trillion market cap. And if you look at China, right, if you just sum up China, excluding those Hong Kong one, is about 6.4 trillion, and then including Hong Kong is like 7.2 trillion market cap. So just 3 US companies is already larger than the entire China and Hong Kong stock market. So I think that's quite impressive. Just to give you an idea that yes, when you talk about market cap, right, indeed US stock market cap is very big. But we all know that we cannot just look at market cap, right? You need to consider the revenue, the earnings, the forward earnings multiple, and so on to justify whether it's overvalued or not. But this one, I just think that it is quite an interesting data point to look at now. Okay, for me, if we just want to purely zoom in and look at US stock market and answer the questions of whether stock market is overvalued now, I think this one indicators, right, which is the forward earnings, right? I think this is the one that I will focus on. The reason we are looking at forward PE and not just the historical PE is because sometimes, when the stock market or the entire economy is experiencing some sort of downturn, right? Actually, all these companies, they are already projecting earnings that is lower in the subsequent, let's say, like 12 months. And usually during that period, right, the stock market also will be a lot lower. So, but if you take a ratio between the price, today's price, which already include the expectation in the future, right, and also divided by the forward earnings, which also include the future expectations, you get a ratio that I think is a good reflective of whether the stock market is expensive or cheap. So you look at this chart here, this is from 1985 until the most recent data point. You can see that the red line, right, is the S&P 500 price index, and the blue line, right, you saw that there are 4 lines there. These are just I think they take the earnings multiply by different multiple. Say for example, if you look at this, so if you look at this, the lowest blue line, right, this is just the 10x of earnings, and then the higher one is 15, 20, and 25x. So you can see that sometimes when so-called US stock market is trading at cheaper level, right, they are trading at about 10x PE or forward PE. And when it is expensive, it can go up as high as 25x of forward PE. So this one itself give a good representations of whether the stock market is overvalued or not. You don't have to, of course, there are many metrics out there, but I think this one is good. I'll usually referring to this when I'm talk about whether US market is overvalued or not. Okay, now, so how should we process this chart, right? So if you will often hear people saying when they are investing, it's not enough just to buy good companies. They will say, I will only buy the company when it is trading at cheap level. Okay, that's referring to single company investment. But let's say even if you just say we are talking about like entire market, the stock index, I believe there are many people who say that, I'm not going to invest at any time. I'm just investing or put my money to work when there's crashes or when the stock market is cheap. So I think their goal, right, when they are saying that, right, I think they are thinking of this. They look at this, for example, like when the stock market is trading at about, let's say, 10x PE or some level that is historically cheap. So they buy and then they sell when it is historically expensive. In this example here, they are buying at 10x PE, selling at 25x PE. So you clock in the profits. Then maybe you buy at 2009 when the stock market is cheap, and then you sell somewhere around recent years, right, where it is trading at about 20x PE. So this is the mindset of like buy low, sell high, which if you just look at the chart, definitely if you can really buy at the point that I show here, right, buy low, sell high, and then buy low again and sell high again, of course your returns will be very good. Okay, that's provided that you are able to time when the stock market gets close to the bottom, and you are able to time when the stock market is close to the top. So definitely this is the the dream, right, of investors. So but just one thing to point out, right, is that what happens if we just put our money to work when the market is expensive? In this case, let's say if I invest my money in year 2000, which I mean, with hindsight, you know that it is really quite expensive, right? At about 25 XPE. Then, provided that you don't, like panic sell when the market crash, right? You just buy and just hold for the long term, right? Is that means that when you're buying at expensive level, you will lose money over the long term? So if you look at the chart here, right, it's 25 XPE when you bought, and if you hold on until now, which is let's say like 24 years, right, it still go up. Just look at the S&P 500, it still go up. I mean, over the long term. The question is why, right? Is that means that you don't really need to look at valuation and just buy it still go up? In this chart, right, it's not just about the valuations that you should pay attention to. I would say if you are having like a short term or medium term kind of outlook, right, yes, it's very important to buy at least at a reasonable valuation, so that it is not as painful when the stock market went from like crazy expensive down to a reasonable valuation. You want to buy at cheap. I know that's the best case, but the question is, even if the stock market is expensive, do you want to wait for them to get cheap? Because you know that over the long term, the stock market is still going up, which is very clear from this chart here. I really like this chart because aside from the index, right, which is the red line, right, you can also see that the blue line, they are trending up, and the blue line is basically it's trend up because of the earnings is trending up over time. So the question is now is how I process this. I'm thinking like, okay, there are two ways to play this game, right? You are either someone who is like a long-term investor, or you are someone who is like George Soros, which is like a trader. Like you play something like a short to medium term outlook. If you are a long-term investor, you shouldn't pay too much attention to whether the red line, right, the index level is a cheaper or reasonable or expensive, because anyway you are going to hold it for like 10, 20, 30, 40 years. So what you should pay attention to as a long-term investor is the blue line. You want to hold on to something that just trending up slowly over decades. But if you are someone who is having like a shorter term horizon, you want to play the short term game, you want to be like trading in and out, right? Then I think it makes sense to trade, buy when it's cheap and sell when it's expensive. My personal approach is always to just focus on the long term, because I really don't like to trade over the short term. To me, trying to like getting in and out and trying to time the market is just too tiring. I'd rather spend my time just do things that I like. For example, like recently, right, I've been playing Chinese chess with my son. I think it's quite fun. It's like sometimes it's like we have some free time. I don't want to spend time looking at all these fundamental like all these valuations to see whether should I get in now, should I get out now. I'd rather spend my time do something that I like, right? So it's supposed to be something that's passive, long term, earnings trending up, and just get returns. Although if you just, arguably you can see that if you buy at expensive, of course your return is lower as compared to buying at like cheap level. This one everyone knows, right? Because the price is what you pay, the value is what you get. So if you buy at expensive level, I would say that please expect that the returns won't be as fantastic. You really want to buy at like depressed level to get those super return. But this kind of like depressed level, it doesn't happen often. Sometimes you need to wait 5 years, 8 years, 10 years just to wait for the next crash, right? So in that case, it's really better just to like just have at least some allocations in the stock market. Like just put there, let it just grow. If you want to time a bit, I think that's okay, but don't make it like 100% in and out kind of things. I'll suggest that you can put some money in like like some liquidity, whether it's T-bills, Singapore saving bond, doesn't really matter. Just put some money into pocket that will not be affected by stock market volatility, and that gives you some options to get into the market when you really feel that there's blood on the street, like there's panic. So that one, I think everyone, you need to do your own preparations. It's better to have some allocations to the stock market that you just let it grow, rather than just thinking that stock market is too expensive. Let's waiting for crash, or just try to optimize that. You are not happy with current 20 XPE, you just want to wait for that 15 XPE. I think that's really, it will take up a lot of energies. I think for those who invested for some time, you will know that trying to timing in and out it's just too taxing in terms of energy. I guess those who invested for like 10 years or longer, they will appreciate more on this statement. But before we close these sessions, just want to come back to why the blue line is trending up over the long term. So this one is really depending on the stock market, and I think US stock market has proven that they have the enough ingredients to make these stock markets attractive to like businesses, to entrepreneurs to build their business there. I think this is definitely something that is attractive, and they have track records showing that they have won in the past, and they will continue to execute in the future. And we are not talking about like 1, 2, or 3 companies, right? We're talking about like the top 500 US companies. Either one of them can fail, but in aggregate, I think they will do well over time. So you can see that this chart here is showing the quarterly. This is the revenue, or I think it goes up also because this is expressed as the dollar per share. I mean, since like in 1990 until now, it's trending up. Do you want to bet that it's going to come down soon? Yes, there are some period, for example, like during recessions, right? It comes down, and during 2009 it also comes down, right? But over the long term, it's still trending up, right? And then the next one is showing the operating earnings. Again, you see that there's period that it came down. Even if it came down, right? If you hold long enough, it still will break all-time high again, right? So this is true in during dot-com bubble, and this is also true during global financial crisis. And even during the COVID crisis, you see that there's small dip here, but it recovered already. So the question is now is that you want to bet the recession coming soon, and I think it's fine to have that kind of like prediction, but please don't bet on 100% of your net worth, where you just park 100% of money in cash and just wait for crash, right? And you are watching at people generating good profit from market, and you have making you FOMO. So I think that's really not recommended. Okay, for longer history, I think this is again chart. It's the most important chart that I think everyone should just memorize this chart here. I think I've shown this like don't know how many times, but still need to show it again, right? So this is like 200 years kind of chart to show that the kind of returns that you can get from different asset class, from stocks to bonds to bill to gold to US dollar. I think you just remember like a few numbers from here. Like if you invest in stock market, right, the real returns. This is not nominal returns. The real returns is basically the return after minus out the inflations. You are getting like 6.9% historically. But again, future return is not the historical return. But do you want to bet that the future returns is significantly lower than the historical return? I won't bet that, right? But I think 100 years ago, when the stock market is not something that people are comfortable with, the valuation is also traded at much lower value. So of course, if you bought then, you can get like 6.9% real returns. But as of now, because valuation is high, I think you should be reasonable. Maybe you need to take like 1 or 2% cut from this 6.9%. To me, I think that real returns of 4 to 5% is very reasonable. And you add that, let's say like just a 2% inflation on top, right? If you invest in US stock market over the long term, I would say that expecting, let's say somewhere between 7 to 8%, that's reasonable expectations. I think that one is fair. The part that people can't tolerate is usually the volatility. Volatility is always tough. You just need to practice, have some money in the stock market, be comfortable with the volatility, and just build your portfolio. And then another thing I want to point out here is that the US dollar is negative 1.4% returns. Actually, this is real returns, right? Meaning that if you hold $1 100 years ago until now, you still have that $1. It's just that the purchasing power of that $1 is a lot lesser, and that's because of the inflation, right? Inflation will really eat up your returns. And speaking of the recent presidential elections, I mean just just look at the performance of two candidates, right? It's quite clear that I think Trump is going to win these elections. I think the way Biden speaks really can't give confidence to the voters to vote him as the president. So but regardless of who win these elections, right, I think what is clear is that when it comes to spending, none of the parties are, or none of the candidates are prepared to make significant cut to the spending. And I think this one, from macro point of view, I think what will happen next is that US will have no choice but issue more bonds to fund their expenditures. And when it comes to tax, right, I think Trump also mentioned that he's not going to increase tax, he's going to cut tax some more. So you imagine that the government tax is reduced, but still they have to continue with their expenditure, their spending, which their spending also include, like the interest cost. So I think U.S. Government debt, right, will just continue to go up exponentially, higher and higher. And just one interesting fact is that their public debt, right, is going to double every 10 years. And if with all these extra spendings, with all this tax cut, with all this, current fiscal environment, right, and interest rate is also a lot higher now compared to, let's say, like past 10 years, right? I think it probably won't take the next 10 years to double their debt from today's level, maybe 7 or 8 years or even shorter. So that's definitely possible. So I think the implication from that is that when the US has so much debt, right? And debt, in other words, is just money, It's just money, M2 that's floating around, right? So more money chasing a similar level of goods, that means inflation, right? If you are not comfortable in investing in hard assets, for example, like whether it's stocks, real estate, or gold, right? If you just put your money in fixed income, bills, cash, right? Just be prepared that the inflations will really, eat into your purchasing power. I think that's the biggest risk for those who, not comfortable in taking volatility risk, and they are thinking that, I'd rather just hold my cash in, like banks. At least it is safe. Yes, it is safe over the short term, over like 1, 2, or 3 years. But as long as you stretch, you just extend your horizon to, let's say, like 10 years, 20 years, 30 years, right? You will really see that your purchasing power get deteriorated like over time. So I think that's the biggest risk of those who are not comfortable taking on risk by investing in hard assets, including stocks. So I think that's all on my sharing today. Just try to keep it short. Let me know if you have any questions or if you agree or disagree with my sharing here, and see you in the next one. Cheers.